get money or banking.
You see?
So for trading institutions that can always sell on a routine basis, that implies they can always have cash with them. So the implication that the nature of the business, if it is a manufacturing company, you'll need to have working capital with you, because having from raw materials to a final product, that means you need the cash to finance the operations. But for a trading company, let's say let us look at people that are in Chukwu. Today you sell or you receive cash, then meaning that you don't have to have high levels of working capital in your business. Are we at that? Then from the nature of the business, we look at the scale of operations. Scale of operations. The scale of operations is basically related to the size of the institution. Big institutions vis-a-vis SMEs. When you look at companies or institutions that are in the same sector, but when one is determined as big or as a medium scale or as the largest manufacturer vis-a-vis small scale industry or a small scale in the company, you realize that the levels of working capital that are needed are not the same. Let's look at institutions that are in education. Look at MAT vis-a-vis maybe Makerere University Business School. When you look at the number of students that MAT has vis-a-vis MOOCs has, and then you scale down to the number of staff that MAT has, then to the number of staff that MOOCs has, you realize that MOOCs is bigger than MAT. So, and remember the collections of MOOCs and the collections of MAT, they are not at the same one, at the same level. So MAT will have lower levels of working capital, because at the end of the day, they know that their payroll has maybe 20 to 25 staff that they have to pay. The levels of utilities that they pay in terms of water and power, they are also not as compared to those of Makerere. But then Makerere will receive the tuition from students at the first day or before coursework. But they will have to pay the lecturers from when the semester starts, even when they are in holidays. That implies they need to have working capital that is so in large amounts compared to MAT, because you realize that MAT, during holidays when the results are not yet out, now like the setting of MAT, they always consider June and December. So meaning that when you teach from January up to May, then when you are in holidays waiting for results and you start off maybe in July, then during that period, by virtue that it is even a small institution compared to Makerere, then they need lower levels of working capital. Are we at par? Then the business cycle. The other point is the business cycle. The business cycle. The business cycle here, we are looking at boom and then depression or recess. So every time we are at a boom, every time we are at a boom, and then every time we are at a depression. Remember, when we are at a boom, that implies there is business. Compare the days before COVID or after COVID and during COVID. Meaning that every time we are at a boom, we have a lot of activities that are running. The company has very many clients. The demand for goods and services is high. So meaning that we must have capital with us, such that we can be able to achieve the long-term obligation of our clients of receiving quality goods and services, and they are available. But every time we are at a depression, at a recess, no customers, then that implies then we don't need to have working capital to put in, because we shall have to manufacture and have the final products with us, but no customers are going to take them on. Like going to the bank, seek for a loan, you seek for a loan to produce the product, but knowing that the demand for the product is low. Will you be in a position to service the loan? So meaning that in periods of the boom, we are in a position to have high levels of work. We are in a position to have high levels of
Marvin, mute.
I was saying that during a boom, we have a lot of demand. So if we have a lot of demand, the implication is we must have working capital to facilitate the demand and produce. But in periods when we realize we are in a depression or recess, then we don't need to get. It's like people who are in COVID. It was during COVID, but funny companies were borrowing. So if you're borrowing and then you are in COVID and you don't have demand, what will happen? Actually, if we go now on a national level, during the COVID, the LDCs were borrowing to facilitate the operations. And then the developed countries were advancing loans to us. And for them, they had a lot of money with them. But we are just giving relief to people. Then after COVID, we have the money, but at the same time, we are not investing it productively. And then the loans are accumulating. So meaning that every time it is a depression, then you don't need to have a high amounts of money with you. Are we at par? Then the other point that it determines, or the other factor, is the seasonal factors. 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 Every time it is a season, let's look at Christmas seasons, for example. The demand is always perfectly inelastic, especially for Christmas cards. But then if the demand is perfectly inelastic for Christmas cards, does it imply that even in January, you'll have the demand for Christmas cards? Does it imply that the demand will be there in January? So meaning that especially if it is Christmas seasons, all seasons that are for high demand, it doesn't imply that you should have high levels of liquidity. Actually, you should have low levels of liquidity. The implication that this is something that is demanded because of the season. But when the season gets off, then at the end of the day, you'll not have that demand with you. But look at scenarios where we don't have season, the demand is not on season. So if you are an industry, you are in a company that is dealing in products that don't have a season, then you must have high levels of working capital with you, because every time the demand will be there. But for seasons, the demand is there, but immediately the season is not there. Then meaning that you don't have the demand. Are we at par? Or it is contradicting. Are we at par? Silence does not tantamount to acceptance. Then the other point is about the production cycle. The production cycle. The production cycle. The production cycle, we are looking at the period it takes for you to convert the raw materials into the final product. If it takes so long for you to convert the raw materials into a final product, the implication is you must have capital with you that will enhance you convert the raw materials into final what? But if you realize that you need a shorter production cycle, then you don't need to have high levels of working capital. If now look at a scenario of petrol, I was giving you petrol. Starting from look at a scenario, do you remember when they discovered oil in Uganda? Right away from the presidential handshake, people have forgotten that. From the presidential handshake, we are talking of oil in Uganda. And up to today, we've not even gotten even 1 liter or 1 barrel. But how much has Uganda incurred in that process of oil? Meaning that the production cycle is very what? Very long. But look at scenarios where you have to produce an item in a week's time, meaning that you need low levels of working capital. The other example could be wine. You know that wine takes more than a year to the final product. So meaning that the companies that are dealing in wine, that is the production of wine, the production cycle for wine is long, meaning that you need to have high levels of working. But if you're dealing in something that you can do today, let's look at warad. You know local warad, crude warad. You have the mobisi with you, you ferment in a day or 3 days, the other day you have the warad with you. Meaning that you don't need to have working capital. Because today you can have the product and then the other day you have also another product and then you serve the market. So you have money with you. Then the other point is the sales credit policy. The sales credit policy. The sales credit policy. Now we have two companies. We have A and B. A sells on cash basis, and then B offers credit what? Sales. And then maybe we shall also have C. C also offers credit sales, but for B, they are very strict. They are saying net 15 days. We are giving you on credit, but within 15 days, you must have paid us. Then C, they are very reluctant. They are saying you can even pay us net 60 days. Now, between companies A, B, and C, which company needs more working capital and which company needs less working capital? C, because for C, when you supply today, you're sure you can even receive the money after 60 days. So what will you be using running your operations? So now the credit policy. If your credit policy is very open and relaxed, people can pay you even after 60 days, meaning that you have the money to finance your day-to-day running operations. But if you come to A, they sell every day and they are very strict. They are selling on cash. Then at the end of the day, look what, I'll give you an example of MTN and Airtel. Do you realize that for people that take credit airtime, MTN immediately you take a credit offer from MTN of airtime, there and then they put your account in negative. Immediately you load, you took 500, immediately you load 1,000, 500 is deducted instantly. But for Airtel, because maybe it is, they have a lot of working capital with them, you can even load 1,000 and then you convert it into minutes. But MTN does not allow. So what is the implication? That every time the credit policy is relaxed, you can always have high, that implies you have high levels of working what? But when you're selling on cash basis, then meaning that you don't have high levels of working capital because you can always get the money with you. Then the purchasing credit facilities. The other point is the purchasing or availability of the purchasing credit facility. Purchasing credit facility. It will come back to company A and B. If you know that your suppliers of A don't accept to give facilities or credit, they will never allow to give you goods and services or raw materials on credit. It is not accepted, no. But then you realize that B, they can always receive credit purchases after sale, then they can pay back. What is the implication? Meaning that some supplier B or the institution B, since they can get credit purchases, then they don't even need to have high levels of working capital. We know that even though we don't pay, we need raw materials we can get from the suppliers. But if we have these suppliers that also need cash to give us raw materials, that implies we must have working capital with us. Are we at par? Then lastly, because there are very many points, I'll talk about the purchasing credit facility. If we have suppliers with us, we have an institution A and B. A as saying A and B. So our suppliers of company A, they only need the cash. They don't operate on credit. But then we have suppliers of company B. The suppliers can offer credit net 60 days to pay. When I say net 60 days, meaning that they can accept after 60 days. Implying that suppliers of A, if we are company A, we don't need to have, actually suppliers of A, we need to have high levels of working capital. because our suppliers don't give us on credit. But since now B has net of 60 days, so meaning that we don't need to have working capital. Every time we need material, we shall get the raw materials. But in A, because we can only pay cash, then we need to have working capital with us. Are we at par?
Yes.
Then lastly, I'll talk about the operational efficiency. Operational efficiency. Operational efficiency, we are also looking at from the time raw materials are converted into final product and even the costs. So every time now with operational efficiency, we are looking at time, and at the same time, we are looking at cost. Every time that we see that the company is operating efficiently and the products can come to the customers and even the customers can pay us promptly, that implies we don't need to have high levels of working capital. But every time we realize that our operational efficiency, one, we can need a product that can take 2 weeks out of the plant, or that can be converted into a final product from raw material for 2 weeks, but it is taking four weeks. Then that implies the operational efficiency is not good. Then that will call for higher levels of working capital. I'll give you an example. Coca-Cola, all Crown beverages and Century Bottling, they are all manufacturing soda. But you may realize that for Coca-Cola, it takes them maybe a week to have soda on the market. But then Crown beverages, it is taking them 2 weeks to have soda on the market. Then that is operational efficiency. And remember, the longer it takes you to have a product on the market, that calls for more costs. And then at the same time, also response. Because we have what we call standing costs, fixed costs. Whether you're operating or not, you'll have to incur them. Security. Do you realize that security, you'll have to pay for the security? There is lighting. You can't tell us that it is a plant, and then you're saying, since we are not operating, we shall not have lighting. If we are paying rent, meaning that we shall also have to pay what? So operational efficiency, every time we are efficient, then it means that then we shall have low levels of working capital because the product can easily reach the customers, and then we turn the product into cash or we sell. But every time the operational efficiency is not well, it takes one, longer period, and then two, we are incurring also more costs. Then we must have working capital with us. Are we at par? Briefly, those are the factors, but there are very many in the book. But I picked out a few that can give us an insight, and then we can build on the others. Then we can as well go to, when we are looking at working capital, since working capital is about current assets and current liabilities, we as financial managers or as accountants, we are looking at the face of the financial statements, that is the statement of comprehensive income, and then the statement of financial position, vis-a-vis the statement of cash flows. You may not get a clear picture to assess the liquidity of an institution or to assess the working capital of an institution. But then this is done by calculating some key ratios. So I'll have to introduce you to what we call some of the key ratios. I'll introduce you to what we call some of the key ratios. The key ratios that we use to assess working capital in our organizations. But these are not going to be, this is not going to be the first time that you are exposed to ratios. I know some of you must have done financial reporting, which is now, is it paper 7? You did the ratios. For those of you that did financial accounting, you must also have done the ratios. But in this regard, we are going to look at those ratios that are specifically on working capital. I'll provide the formulas. Then in your free time, I'll request you can always have the financial statements, the draft financial statements, and you compute. but I'll give the insights and explain which each ratio it means to you as an accountant. Because for this diet, I'm basically supposed to introduce to the ratios, because we have a lot. We have to look at management of receivables, management of inventory, and then also management of receivables in core. But for purposes, you never know nowadays, the examiner is very funny. You enter an exam, he says, he brings financial statements, then he says, can you compute the liquidity ratios and advise on the working capital of the institution? So at least let us get introduced to the ratios. But if at all, professor, because it is his norm for paper 16, which is paper 15, to start with the ratios. If maybe he covered the ratios, we can forego them. Did he cover the ratios? So let us at least look at the key ratios. The first category is the liquidity ratios. The liquidity ratios. The liquidity ratios. The liquidity ratios. And under liquidity ratios, we shall look at the current ratio. The current ratio. So the current ratio, we are basically looking at the current assets over the current liabilities. 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 I think at this level, we can differentiate what we call current assets and current liabilities. What are some of the examples of current assets that we have? Let us not just assume, because we may be here, then someone gets longer term loans, you find them in current assets. We have some of the examples of current assets. We have cash, we have receivables, we have cash all, bank, inventory, maybe for purposes of learning. If we come to the reporting side of financial reporting, where do we classify? Which standard do we use for receivables? Receivables. Have you heard of financial instruments? So when it comes to cash flow bank, when you advance, you'll hear this man called IFRS now, financial instruments. Every item you see in the financial statement has a standard on how it is treated. Then inventory, which standard is that? IS2, that is the law of cost and net realizable. And then you inventory, that is IS2. And then also under inventory, maybe you may be interested in knowing the different methods of valuing inventory. That is the FIFO. We have LIFO, and then weighted average cost. So we've talked of the current ratio, that is current assets over current liabilities. Then the other ratio that is under the liquidity ratios is the quick ratio. The quick ratio, and the quick ratio is almost the same as the current ratio. The only difference is inventory. So we have the current assets minus inventory over the current liabilities. The reason as to why we deduct the inventory, in most cases, inventory takes some substantive time, and at times we may value inventory without putting in mind the obsolescence. So for you have inventory with you, but actually when some of that inventory is damaged or outdated. And at the same time, inventory takes time to be disposed of. So for you to have the quick ratio, we always get our current assets, you deduct inventory, then we divide by current liabilities. So you note, if they say calculate the liquidity ratios, the current ratio and the quick ratio, the difference is the inventory.
Do we equate them to 1?
Sorry?
Do we equate them to 1?
Do we equate them to? Like equating them to 1. Of course, all of the ratios that you're computing, you have to, the benchmark is always what? Is always 1. Then from yes.
I have a question.
Yes.
Is that quick ratio the same as the quick acid test?
The quick
acid test.
The same as the quick acid test. Actually, when you look at these ratios, when you go to Google, some of you go Google to directly, and then it confuses you. For example, when you go to Google, an example is on, the best example is on the receivables. Someone will find receivables and it is accounts receivables correction period. Then the other journal says it is the debtors period. Then the others, they just say correction period. Then for you, you find one scholar saying receivables, then the other one is saying correction. Then without asking yourself, when do we receive the correct? The corrections are coming from receivables. Are we at par? So it is the same. Yes. Inventory. In most cases for accountants, we are looking at closing inventory because the opening is coming from another financial year. It is not for that particular what? For that particular year. The real inventory, we are looking at the closing what? Closing stock. And that's why the emphasis is always on the law of cost and net realizable value, on what you have at the close of the what? At the close of the year. Then the other one from the liquidity ratios, we look at the efficiency ratios. Efficiency ratios. Efficiency ratios. Now, efficiency ratios, that's where you find the accounts receivables, period, or what others call correction period, or at times some others call it the debtors what? Debtors period. They all mean the same. So here we get average receivables, then over the sales, then times 365 days. Times 365 days.
Excuse me?
Yes?
There is this third word you wrote here. I don't know, you cannot read it well.
Debtors period.
Okay, okay.
Debtors period. Accounts receivables, they are the same as debtors. So we get the average receivables over the sales, then times 365. But you must take note, if they don't give you the average receivables, if it is not mentioned now by osmosis, you just get to know that the other one is 0. So the receivables that have been provided becomes the average receipt. Because you are in an exam and you're saying the formula is saying average receipt, but already you have, meaning that if maybe you're not given the maybe 2 years, then meaning that now the other year you assume it is what? It is 0. Are we at par? Then the payables, the other one is the accounts payables. The accounts payables period. The accounts payables period. Or the what they call the creditors what? The creditors period. So it is also average payables. Average payables. Now over cost of sales. Over cost of sales. over cost of sales. The other one was over sales, but this one now it is cost of what? Cost of sales. Then time, of course, time is 360. 365. 65. Then the other one is the data's turnover ratio. The data's turnover ratio. The data's turnover ratio. The data's turnover ratio, we are looking at the net credit sales. The net credit sales over average receivables. Over average receivables. Over average receivables. Take note that the first two items we are looking at 365 days. So meaning that those ones we shall have days. But now this was now a ratio. We go back now to the first one. The benchmark is what? Is 1. Are we at par?
Excuse me?
Yes.
What is the use of that data's turnover?
Data's turnover ratio.
Sure.
The data's turnover ratio. We are looking at, you have the time it takes you, you have the time it takes you for the data to pay you. But then the question is, if at all I have my receivables with me, then when we talk of the net receivables, do you know that there are some costs that accrue on credit sales? There are costs that accrue on credit what? If I give out credit sales worth 200 million, then at the end of the day, when I'm collecting them, I put on maybe an agent to help me collect. I always make calls. I send reminders. Now I'll come back with my net what? Sales. But how much money did I expect from these people? If I expected 380 million, but then at the end of the day, I'm getting 300 what? Million. So meaning that now I'm looking at how much I'm recovering vis-a-vis what I'm expecting to what? To earn. Are we at par? My expectation from receivables was 350 million. But after looking at the amount of money that I'm using to get now my net what? My net credit sales, I'm realizing that 350, I'm getting 300 what? 50. So I'm looking at what is the ratio of how much I actually target vis-a-vis what I expected. So meaning that every time now it comes to us when we are in business, you get to know that this customer, the chances of this customer defaulting is high. Then at the end of the day, that's why you realize that we always ask for higher price. If I'm supposed to sell an item at maybe 1 million, I'll charge you 1.3 million. Or I realize that maybe you take long to pay me, and now the bank will keep on charging me interest. So if I'm to ask myself, I supply the goods to you worth 100 million, but I gotten this money from the bank, I needed 70 million, and you're paying me after 6 months. Should I charge the same amount of money to you, to the same amount of money to supplier A that is going to take 1 month? That's why every time people are transacting with the government, you realize the market price of an item is maybe 100 million, but the person is saying, if I'm supplying the government, I need 200 million. Because at the end of the day, at times you realize that the money that you're supplying or the item you're supplying, it is not even in the budget. It is going to be incorporated in the following financial. And the requirement is very simple. No accounting officer will authorize any payment that is not on the what? On the budget line. So you're waiting for extra 6 months for the pay. So the question is, if you're to get that money and you got it from the bank, are you getting the net sales that you expected from that money? So we are looking at the relationship between what you expected and actually you receive. Are we at par? Then we have the inventory period.
Excuse me, sir.
Yes.
On payables period, I was referring to the formulas which were provided in the notes.
On the pay,
Average payables over cost of sales or over purchases.
you're saying you're referring to
The formulas which were provided in this the workbook
I have the book with me also for reference.
under ratios.
Let's go to ratios there on which page? 151. One. I don't have one. I don't have.
128.
I wouldn't have wasted time to give you these formulas.
128.
Here, to me, the coverage here, I wouldn't have wasted the time to pass through these formulas if I saw them here. That's why I was asking you 120. But also to answer your question, we need to be very logical.
Yes.
Cost of sales is an equivalent of, if I can use this, how do we get cost of sales? It is opening stock plus purchases minus closing. So you are in an exam and the examiner is saying, and for you, you're saying cost of sales and you have purchases. If you don't have opening stock and stock is zero, but you have purchases with you maybe 300 million and you don't have closing stock, by default, the cost of sales are equaling to purchases. So at times we also need to be very logical. Are we at par? And these are things that will come. And I must question you that the examiner for financial management and advanced financial management is very knowledgeable in financial reporting. That's why if you can refer back, I started setting in 2019. If you can see the flow of those questions have a very, very big flow of accounting. Like if we come to the cash operating cycle, you're going to realize that he reached a level of setting something to do with a prepayment. He knew that if you are an accountant, he knows that you know that a prepayment is part of the current what? Asset. But previously, those people were not setting the prepayments. For those of advanced financial reporting, when you look at corporate restructuring, he at a certain time he set revaluation reserves, but knowing that it was your responsibility to know that revaluation reserves, that is accounting information. It is not a cash flow information, so you have to leave it out. So he assumes that you people know the accounting. So if he doesn't bring opening stock and closing stock, but you have the purchases with you, then you say, the examiner didn't bring cost of sales. So the inventory period, how do we get the inventory period? That is average what? Average stock or average inventory. Average inventory over the cost of sales, of course, time was 365 what? 365 days. We said it is average stock or average inventory. Average inventory, then over 300 and sorry, it is opening stock It is average stock, which is opening plus closing over cost of sales times 365. So the reason as why I provided these formulas, we are going to look at the cash operating cycle. And in the cash operating cycle, we are going to extract these formulas such that we get these days and we come out with a cash operating what? Cycle. Maybe for purposes of class, that's why I provided them. But let me add you. Have them off head. Have them off head. CPA is becoming very funny. Me, I'm also a student like here, I can tell you. I'm doing public finance management. It is very funny. You find, and the new syllabus is very funny. You find someone is setting something that is coming from another paper to this paper, and there is no way you restrict them. They say that is knowledge accrued from lower levels. So let us be conscious. Those people that start advanced financial reporting, reaching the paper, part B of question 2, the guy is saying compute the ratios. When someone left the ratios at level 2 and they are not part of the syllabus, people are expecting consolidated cash flow. Very simple things. He says, compute the ratios. Part B says, explain the relevance of the conceptual framework. And the people are here, you ask them to define an asset. They say, that is financial accounting when someone cannot define an asset. But the guy will say, differentiate between an asset and the liability. 5 marks, and you know for CPA, you get in the 47 plus those 5 marks, there is a difference. Always the prize winners have 65, and they say that one got in the prize 65. And if anyone has ever gotten a 48 here, that's when you'll know that the 5 counts. Because I know most of us, we just want the 50 and go. 50 and go, yes. I personally getting a prize is, it is like getting a prize is good and it comes by default. I know how it feels because I've ever gotten it for advanced financial management, but it is like luck. Yes, I can tell you it is luck, unless otherwise, because you are 1,000 students. So let us take those 5. Now, like we've been doing the factors, someone will say, when will he take the factors? The factors come, you don't know any, you're focusing, and especially these papers, people are focusing on calculations. You're going to come to paper 15. One of the reasons why people fail, they focus on computations. They do a lot of computations. Then the examiner sets a question, 25 marks. 15 is typically theory. 10 marks is calculation. So let us utilize now these ratios. You get time and pass through. They are not in the syllabus, but don't get surprised. And those of you that dodge the engagement seminars, I was told, I had it in grapevine that nowadays they are even removing these things of compulsory things. You don't read the ratios, you expect in capital budgeting, the guy brings ratios as compulsory. And I remember when you check those papers on paper 10, he has ever done it. He changed from capital budgeting, he brought ratios. Very simple things, but for you saying, I did not plan for that. So let us be conscious. So those are some of the efficiency ratios. So my target today was about the cash operating cycle. So I want us to get into an introduction of the cash, because it's something that I feel that is new. Cash operating cycle, the cash operating cycle. Sorry, which page? Page of the book. I think it is page 156. The cash operating cycle. The cash operating cycle. It is 156. Now the question is, why do we trade? Is it 150? It's 156. I don't know. To the book that I have. To the book that I have, it is like that. Let us ask ourselves. For us, I'll use scenarios because by nature of the way we teach, that's what we use. I'll ask you, all of us that are in trade, if it is a manufacturing firm, if it is a trading firm, the question is, what are we interested in? Cash. You find maybe Mukwano Industries, they are making soap, they are making plastics, but the end result, they are interested in what? In cash. Yes, there is no company that is in Uganda when they are not making cash and they are very happy. Because, and profits, leave these things of the accounting things, where you declare your profit, but when you go to your bank, it is zero, or you have a bank overdraft. But we are all interested in what? In cash. So the question is, from the time when you get the raw materials up to when you receive cash, that is what we refer to the cash operating cycle. We are looking at the series of activities that take place from when you convert the resources or the raw materials up to when you get the final what? Product, or up to when you give in an invoice and you receive what? Cash. Then when it comes to a trader, we are looking at the time when you have this inventory with you. Now you've bought from Mukwano, maybe the jerrycans, having them at your shop, and then till when you supply them to somewhere, or keep them in the supermarket, and then the customer comes and picks one, and you receive what? Cash. So, sorry, I had someone asking. So the cash operating cycle, what we call the working capital operating, is the average. Yes.
What of if the scenario of a service?
Of course, when it comes to the service, the best example of the service I'll give you is a salon. Immediately you enter the salon for the ladies. When you go to a salon and you want maybe to plait the hair, do these people always have the materials with them? Also, the salon has consumables. If I buy the consumables with me, I'm a salon, I'm dealing with the ladies. There are times when you realize that no one is coming and you bought the Vaseline with you and it will get expired. That's why you realize even these salons are very, very technical. When you go, the ladies, you say, I want to plait, is it called Brazilian? She will tell you, give me the money and I can't buy the bra, because they know that Brazilian is not a fast moving what type of commodity. It is for limited few. But I don't know, is it called the twist? They have always that kind of hair, the cheap hair with them, because they know that the cash operating cycle every day, everyone will come. It has the demand is high. So also the service, you take note, by the time you get the consumables with you, hold the consumables, and then deliver the service and invoice. It takes also some time. So when you look into your notes, they are saying the average length of time between payment for purchased materials and receipt of payment for receivables. Remember, where you get material, you have to pay, meaning that you're making an order, but at the same time, you're also going to receive what? Cash. Are we at par? So that is the cash operating cycle, or what we call the working capital cycle. But my interest is on the computation. So let us have the format on how we compute, and then we do, that is question 3. Question 3, that is CPA 10, May 2018. They examine that. Sorry? So how do we get the cash operating cycle? The cash operating cycle, remember we said for a manufacturing firm, we start from raw materials. So now within our template, we have the raw materials holding period. Holding period. You buy the raw materials, then at the same time, you're looking at the time it will take you now to now push the raw materials to a level where they will be processed. Because we have some industries, you buy, look at Kakira. Have you ever thought of that sugar is also inventory to Kakira? How many of us have done financial reporting? How many of us have done financial reporting? Have you heard of IS 41, agriculture? Do you realize that agriculture, the sugar canes, they are inventory? So now look at Kakira. Sugar canes, they are inventory. So how much does it take them to have, if they have their plantations with them? Have you ever thought of the process of having cash from the sugar canes? You plant, you wait. So IS 40 for reporting will apply. So now Kakira, they look at the time it takes them to plant the sugar, and then also looking at the harvesting, then they process the sugar and then get the sugar canes into sugar. So we have the inventory, the raw material holding period. Then we had on the work in progress, the work in progress holding period. The work in progress, we add on work in progress. Then now after work in progress, remember we have three types. We have raw materials, work in progress, then finished what? Finished goods. Now they are finished goods. Then we ask ourselves, the finished goods holding period, the finished goods holding period, the finished goods holding period, it is also an addition. Then after now goods are ready, we have an assumption that we are now not selling, especially the manufacturing firms. They don't sell on cash, but they will always sell on credit. So now meaning that every time the sales are the final products are ready, we are now going to sell them on credit, meaning that we are looking at the time it's going to take the receivables to pay us. So now we also add on the receivables what? Collection period. The receivables collection period. So now that we have the receivables collection period, the question is, where did we get material from? From the creditors. So meaning that we also have to pay the creditors. So now from here, now we shall come and say the payables, payment what? But this way around, because now these are creditors, we less the days. And then we come out with what we call the cash operating cycle. That is now meaning that we are looking, actually the best way, even though you are in an exam and you forgot it, you look what? Starting from raw materials. And now what makes up, actually you look at the scenario, what makes up goods. We have raw materials, we have work in progress, and then we have finished what? Finished goods. If you look at a manufacturing firm, when you look at the stock they have, they'll have to account for raw materials. If it is Kakira, they'll apply IS 40. Work in progress, they value work in progress, then they had unfinished goods. So you look at the raw materials holding period, the work in progress holding period, the finished goods holding period. Then after the goods are ready, the receivables collection P, then you less off the accounts payables payment period. Then you come out with the operating what? Operating cycle. And now this is applicable to a manufacturing what? Firm. Now let us ask ourselves, to these people who are in trading, the wholesalers and the retailers, remember for them, they don't manufacture, but for them, they buy when the goods are already for what? For sale. Meaning that for them, they don't have raw materials, but this way around, they'll have inventory. So now for wholesalers or retailers, meaning that now we shall start from inventory, all finished, holding period, Then now, since we've now supplied the inventory, meaning that we expect now to have our receivables with us. These people have not yet paid. So now we come and add on the receivables collection period. Then after getting the receivables, of course, now we add on now the payables payment period. We less the payables payment period. Then the resultant, it will be the cash operating cycle. The cash operating cycle. Hopefully we all have the book. Do we all have the book with us? Or we can refer to the question papers. So here on page 157, we have that question that is May 2018. May 2018. Should we go for a break or we are comfortable? Sorry? Sorry?
Comfortable. We are comfortable.
Yeah, we are comfortable. So we do the example. We do the example. We are looking at May 2018. Question 3.
Which page?
According to the book I have, it is page 157. And 150 and 153 to those that have the old ones. Me, that's what I have. This is new. I'm told this is a new stock. So can we get a volunteer or we can read at our own day now? We can go to the required. So maybe we go straight, we first go direct to the required, and hopefully we all are aware here in CPA. Don't start with this Rugambo. The first 15 minutes they give you for reading. Don't read these questions all, the passages. You first read the what? The questions, because the questions are the ones that are testing what you know. If you see, before even you read the background information and the man is saying, explain the term cash operating cycle, and you didn't read about the cash operating cycle. I did even to go and read what is there. Because I've already known what they are asking. Even I go back to the passage, this is not like primary, where you pick answers from the paper. So you just read the required and then you get to know whether you're going forward or, but you find someone reading the entire passage. Then after, when you read the question, you say, this one is not mine. Then you move to another one. Read the required. Then required, explain the term cash operating cycle. Roman number 2, assuming a year of 365 days, compute the cash operating cycle from the information given above. So now you go back and you look at the information that is what is given. We are saying Zebra Uganda Limited is a business that requires holding significant amounts of inventory. Some information about Zebra is given below. We have the statement of comprehensive income and extract 2017. We have the sales in millions, all amounts in millions. We have the sales, we have 8 trillion. I think it is 8 billion. 8 billion, we have the cost of sales, we have 7.2 billion. Then we have the extract of the statement of financial position, 2017 and then 2016. We have inventory, we have receivables, and then we have the payables. And then they are saying you compute the cash operating cycle. So in most cases, if they are saying compute the cash operating cycle. Ideally, before you forget, why don't you first ask yourself, how did I compute the cash operating what? Cycle? And by virtue of the information that has been given to you, you're not seeing something to do with raw materials. We are not seeing work in progress. So meaning that this is not a manufacturing what? Farm. So we are now dealing with a wholesaler and a retailer. So what is the implication? Meaning that we shall start with inventory. So now what shall we do? We shall say now we start with the inventory days. The inventory days, then plus. When you look at the information you have, you realize that we have receivables. So now we shall also come and say we have the receivables collection period or days. Then basing on the information we have, do you realize that we have also the payables? So, and remember we said minus the accounts payables. Sorry? I heard like someone was complaining. The accounts payables period. To me, when I look at the information that we are provided, I don't need to look for work in progress and working what? Or someone may put all of that, but then it is a matter of wasting time to put zeros. So now after knowing that the cash operating cycle, we have the inventory days plus the receivable collection period minus the accounts payable, but you realize that all of these things are not given. You realize that all of those that are not given. But the question is, can't we use the information that has been provided to compute the inventory days, the receivables correction period, and the accounts payables correction period? Then that's the reason as why we started with the formulas. So I would beg that everyone tries. It is not by mandate. If you feel like we cannot try, but we can do together. But remember, in an exam, you do alone. So we can proceed. We can start with the inventory what? The inventory days. We can start with the inventory days. We shall work together. So how do we get the inventory days? Average stock or average inventory over times 365.
And the handwriting.
What's wrong with the handwriting?
The handwriting of accountants.
Excuse me?
Is win. I don't.
Yeah, no, the numerator in the formula is not clear. Those characters are not clear.
And I forgot to move with the calculator. So for those of you that are calculating, we shall go with the majority. So now under average stock is always opening stock plus closing what? So when I look at the question, the opening stock was 96.
Oh my God. I've liked it. I like this.
So people want us to write everything. So divide by 2, then over the cost of what? Cost of sales, which is 72 millions. Without forgetting, we are multiplying by 365 what? Days. So what do we get? But if you are in an exam, to be systematic, you must at least have the workings. It is always better when you are arranging your work, you can leave the first, you can say inventory correction days, then you come down, you say workings. So our request, what are the days?
50.
Sorry? 50 days. So we have 50. We have 50 days. So when you look at the inventory holding period, we have 50 what? So meaning that we as well need the receivables correction what? Period. So we proceed and have the receivable correction period. So how do we get the receivables correction period? We said we get average receivables divided by, we said sales, because sales lead to 10 times 365 what? Days. Oh, we have 40 days. So according to the information we have, what are we remaining with? Yes. Of course, if the assumption is we have a question that specifies cash and credit sales, then we must use credit sales because the receivables arise from credit what? But if you're just given sales, then we shall assume that all sales are credit what? Credit sales. Thank you. Are we at par? Then we have the accounts payables, meaning that now that is the correction what? The correction period, the accounts payables or creditors what? Period. Accounts payable. So what do we have? 29 days. Are we at par? Do we all have the 29 days? So now we shall just extract this information and prorate it in our what? In our cash operating cycle. So we just proceed and now we come and say, is the company is Zebra, Zul. So Zul, cash operating cycle. So what do we have on inventory? 50. Then on receivables, we had 40. Then on payables, 29. So what do we get? See? 61 days. So meaning that the implication when you look at Zul, from the time they get inventory from their suppliers, we are looking at, because they are wholesalers and retailers, to the time of selling and then getting payments and also paying them back, it takes 61 what? 61 days. So, and this is how it will come, but because you don't know the formulas, then you say this thing was very hard. But was it hard? Very, very simple. Very what? But I know what makes CPA hard. We don't have time. We don't have time. But the mere fact that we don't have time, I always tell people that what happens if you every day you read for 1 hour? I'm just asking myself, if you start on the first day and you read for 1 hour, you wake up from 2 to 3. Sorry? Hopefully you know that having a professional course doesn't take you at a managerial level. So you'll have to go for the masters. And now, if you are lucky, you go to movies where you'll have to meet the supervisors, the likes of Professor Munene, the likes of Professor Antai. He sees the students from 5 a.m. to 7. So if he's seeing you from 5 a.m. to 7, meaning that you have to leave home at 4:30. Yes, the PhD students, they attend to them from the sessions, they start from 3 to 6. Yes, 3 to 6. So now what does it cost? Because I'm sure most of us here, you can't sleep marathon. So immediately you flash, it is at midnight. You slowly get out of bed, read for what, that 1 hour, you do a number, you can't sleep. So that 1 hour, when you look at that 1 hour for 4 months, it counts. It is easy because me, that's what I've been doing. During the day I'm working, but at night I know. People are laughing. Do you know that during the day we are working 8 hours? So the course wasn't structured for singles. That's why it is evening for married people. So if we can go now to Roman number 2. Roman number 2, we are saying, suppose Zul was was an internet bookseller charging its customers credit cards, which it sells when it sells books, and it gets paid by credit card firm, usually in a day or even before the book reaches the buyer. In such a case, advise Zul on what should happen to the cash operating cycle. Let us first leave this one and we do the calculation. Because my main interest is on the first. Let's first do the calculation, then we come back. Let's look at 4 and we first do the calculation before we get tired. We are saying, suppose you're given information regarding Zulu's statement of financial position for the year ended 31st December 2017, including 100 million cash, 100 million, prepaid rent, 200 million, accrued salaries, 150 million, overdraft of 30 million, and then the 2-year loan, term loan, 500 million, and then non-current assets of 1 billion. Then they are saying calculate the working capital required by Zul to meet its obligations as they fall due. So what are the major components of working capital? If someone talks of working capital, and you have the statements of financial position, what do you think of? Current assets, less current liabilities. And now we are told to consider only 2017. So meaning that we have our statement of financial position. So we are going to look at items of 2017, and then at the same time we look at the additional information and we determine the working capital. So meaning that if we come and say Zul working capital requirement, that is 2017. We can say that we maintain all our amounts in millions. So we shall have our current assets. So we are going to work together. If you look at the statement of financial position in 2017, which current assets do we have? Which current assets do we have? Meaning that, no, I'm looking at the statement of financial position 2017. We have an extract of the statement of financial position.
We have inventory.
So we have inventory. Before we go to the additional information, they are saying you're given information regarding Zuri's statement of financial position for the year ended 31st December 20. So let us first concentrate on the financial position 2017. You look at, see that. So we have our inventory. Inventory is at 1020. Then which other item that forms the current assets? We have the accounts receivables. And the account receivables, we have 900. Then now we can cross to the additional information. In the additional information, do we have any current assets? So we have cash of 100. So we shall have our cash. Then we are told, do we have any other element of the current assets? We have. Now that is where the challenge comes. Someone doesn't know whether prepaid rent is what? So do we have any other assets, current assets? But do you realize that in the question we were given non-current assets? Yes. So now someone will come out and say add non-current what? Assets. And put in mind, this is not reporting where they mark interest. Financial management, they mark the final answer. Yes. Now this one, now just imagine someone saying working capital and you put non-current assets. If you are the examiner, for sure. And someone is making working capital and putting non-current assets. You even get disturbed and you give 0. Yes. Because they are looking at the concept. So what do we get? I think we have 2.
3.20.
20. It is 2.
220. 3.20.
We have triple. Triple 20 like that.
Yeah.
So now what is our total current assets? So now we can proceed and have our current liabilities. So we first go back to the statement of financial position. Current liabilities, what do we have? We have accounts payables. Accounts payables, that is 6 what? 600. Then when we go to the additional information, we have accrued what? Accrued wages. That is 150. What other current liability do we have? Overdraft, OD, and that is 30. Do we take the 2-year loan term? That is a liability. So what do we have as the total? Say? Like that?
Yes.
So what is the working capital that is required? 1. Like that. So you imagine if you were in that exam. We've not yet done Roman number 2. Is it Roman? We finished Roman number 2. 3. So if you are in an exam, these are the things that you have to do. But surprisingly, you people look for cost of capital, which is very malicious. IRR. Irredeemable debt, irredeemable bonds. Yes. So we spend a lot of time there without reading this one. So you should first get this low-hanging fruit before you do those hard work. And also you should also get the tactics of passing. Never start with the number you're not comfortable with. We have a tendency, people here, they say we start with section A. You bias the examiners. You start with a number you are familiar with. You get 20. Actually, I was telling Professor when I got an out of my paper for June 2022, we left. He told me, if you don't get the prize, we are no longer friends. Then I told him it is known that I'm going to get the prize. But when I got into the paper, I knew everything, but time could not allow. Yes, I knew all the phone numbers in section B and section A. So I said, now to kill this examiner, let me start with section B. I did the first question and I knew everything. Then I said, let me do also another question in section B. Portfolio.
Kindly scroll up.
So,
Yes, please. Mhm.
Just from where the answer started from.
there.
The answer for the next part.
Oh, yes.
Right there. Thank you.
So,
Thank you.
when these people of ISPA came and said 1 hour to go, remember you're supposed to use 1.5 hours for section A, which is 50 marks. Then I looked at what section B, I said, what can I do? It was investment appraisal, AAR. I did the accounting profits, and I got an AAR. Then in part B, it wanted profitability index. Remember, this is accounting information, and this is now cash flow. Right? So it needed a lot of time now to refine and get accounting information. I skipped that one. It was 12 marks. Then I went to part B that had the advantages, disadvantages, Islamic finance. So when I came out of the paper, I found Professor here. I'm like, do you know, Professor? The 12 marks is forward. So I don't think I can be competitive. But surprisingly, the people that
Scroll
finished,
down a little.
please let us obey the bosses. So surprisingly, I passed. So it meaning that you bias the examiner. I'm sure the examiner was biased. You mark section B, you say, this one is good. You mark
Again,
also
just
the
scroll down.
But some of us, we start
Up,
with
up. Oh.
they are stable.
Not yet. Down. Like the part for liabilities.
So I think as he's
Thank you.
eating, we can go for a break. Then we come back and proceed. What did I score? I got a 980. Yes, an 8. 8. Impossible. I got a 980. In advanced financial management, June 2022, I got a 980%. So meaning that you are biased to the examiner. But for you, you move musururu. Now he marks investment appraisal out of maybe 40, you have 12 or even 6. But there is something that you know better. Why don't you start with that? He knows it is about collecting marks. Meaning that when you start with something, you know you get 15, already you have that. Someone is already biased that this candidate is looking for what? For 20 to pass. But for us, we are saying, let me start with that. So I think we can go for a break, then we come back. We can look at something to do with overtrading. Maybe we call it a day.
Look, how wrong.
Yeah. Ndio kwa music. Mama. Mama. Wait. What?
This is all that remains, this beautiful possibility. Where the famous clock is Arsenal's destiny, whatever that may be. It's twisting. Like no one else. Get back to cheering. Will lift the Premier League trophy, and it just might be our
Can we resume? Can we resume? Okay, we can resume. Maybe we can start with, we can look at the analysis of Roman number 3, and then we proceed to something else. Do you realize that Roman number 3, that's why I brought back this, such that we can analyze together. They are saying, suppose Zul was an internet book seller charging its customers credit cards when it sells books, and it gets paid by credit card firm, usually a day or even before the books reach the buyer. What does that imply? Before even the customer receives the goods, the credit cards are what? Meaning that indirectly you receive cash before even the customers, you don't even have receivables to pay. Then when it comes to inventory holding period, meaning that at the end of the day, since you are even operating on the internet, it is 0. So do you realize that now it is Zul that is in negative? You are receiving cash before even you give the SAP. So meaning that this way around, the way to answer that was the only thing they wanted is to tell them that the cash operating cycle for Zul would be negative. Because one, since it is internet, meaning that you don't have inventory period. Then two, because you even receive money before the customer receives the product. Remember, every time the customer receives the product, that's when you invoice and have a receivable. But this way around, it is a return. You're receiving customers' money before even they receive the product. So in that way around, it is now the customer, meaning that now we have a reverse cycle, meaning that now your cash operating cycle would be negative because it is the customer that is expecting the goods from you. You're receiving before even you do give a service. Are we at par? So you would just say the cash operating cycle would be negative because even Zul receives the cash, and even when the receivables are zero, meaning that Zul has an obligation. It is now the Zul to have the obligation. Are we at par? And you could get the 2 marks.
Pardon on the comment, please.
When you realize that when you come to the side of inventory holding period, we said that this is, the books are based on the internet, meaning that is 0. And then the receivable collection period, by virtue that you receive even the money before the customers receive the books. Because the money is deducted on customers' what? Accounts. Look at an example when we are buying online. You realize that when you're buying online, before even you receive something from Amazon, already your credit card has been debited. So in that way around, you realize that the cash operating cycle is negative. It is you who's now demanding Zul than even Zul do what? So meaning that it is even reverse. You're receiving before even you have an obligation to the customer. Are we at par? Do I need to go to the factors that are affecting the length of the operating cycle? Do I need to explain those ones? Ideally. Those ones, basing on what I explained the other side, I presume that we can ably expound. And my intention was, if we can use this theory, we can use the next 30 minutes and we can rest. Then, because it is not about staying so long in class. Someone is laughing. Me when I'm teaching at that side of the university, I enter 15 minutes later and I leave 15 minutes early. Because I know people are tired, especially evening classes. Those ones that study from 7:30, the master's students, they come, some they are calling them at home, food is not yet prepared. The maid is also delaying to serve the husband. So you have to finish early. So I think we can look at overtrading. 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 Overtrading, I'll give you some good examples with overtrading. Are we safe? As saying overtrading, I'll give an example in Uganda. For those of you that are Uganda, they say have you heard of companies here in Uganda that have come onto the market? These companies, they all take over the market. Then all of a sudden you ask yourself, where have they disappeared from? Those days when Walid came, what happened? It came, it introduced the Pakalast. And every student and every Ugandan was enjoying the Pakalast. You load 1,000 and today the following day is free. But what happened? Walid was later on married with, and it is not Walid that married, but Airtel was the man to take over what? Walid. So what is the implication? At times, you realize that the business is over expanding without looking at the resources and the capacity it has. And this happens so much. A company starts today. Initially, they have been operating in only Uganda, and that is where their head offices are. In just a month, because they have made a profit of 100 million, then someone opens up a branch in Mbarara from Kampala. Then from Mbarara, they open up a branch in Arua. Then from Arua, you hear they have opened up a branch in Kisoro. So meaning that they are expanding very fast, but without knowing that what has made Kampala prosper, maybe the manager in Kampala is very aggressive and has understood the business. Then you get this junior person, you take this junior person into Mbarara, but then the junior person cannot perform like them. So meaning that in this way around the overtrading, we are seeing businesses over, they are expanding, but without looking at the limits of the resources that they have. The resources could be in terms of cash. The resources could be in terms of human resource. That's why you realize that companies, multinational companies, if you look at the groups, MTN, it is in South Africa, the head office. But you realize that MTN Uganda is not performing as MTN in South Africa. Then you realize also MTN Uganda is not performing like MTN in Southern what? Sudan. But then maybe for MTN, we can realize that MTN has very many resources. But look at small companies. You're expanding beyond what you can take on. Or if it is like we who are studying, you're doing 5 papers, but the capacity of your medulla oblongata is 2. So now that we call it over what? Over trading. The business is growing so fast, but with insufficient funds and also with insufficient resources in terms of human resource. So meaning at the end of the day, you may end up making what? Making losses. That is what we call overtrading. Are we at par? So let's look at the causes. Causes of overtrading. Causes of overtrading. One is overexpansion. I think that one is self-explanatory. Overexpansion. Because you think you've brought a new product, so you want your, have you heard of what we call intensive distribution? There are companies that use that strategy. Because you've known that maybe people want that milk, it is cheap. So now you expand everywhere, but without knowing that there are people that may not even be interested in what? In the Lato milk. Lato milk is cheap, but you may find that for the rich one, they look at it as an inferior what? An inferior product. They are not consuming it. You may realize that when you go to Kororo, people are not taking Lato milk. When they find you with Lato milk, they say, no, this one wants to infect our kids. So for them, they know that it is SM what? SME. SME or SMA. So then the other one is poor utilization of working capital resources. Poor utilization of working capital resources. Poor utilization of working capital resources. Now, we said one is expansion. When a business is to expand, remember when you go to the capital structure of a firm, you either have debt or equity. So if you have debt or equity, in most cases, one of the main sources of finance for business, especially working capital, is the retained earnings, your own money, which is part of equity. So you're getting the resources, that is especially the retained earnings, but you're misappropriating them into ventures that may not be what? May not even be viable. And especially when it comes to expansion, let us not focus on expanding in one venture. We have companies that since you've known that I'm celebrated in the making of maybe bricks, let's say when you look at Uganda clays, then you're thinking that even max funds will be liked by what? So you transfer working capital that you have. You say, after all, I'm not borrowing. Let me also invest in max funds. But without knowing that you may not have the same quality as the bricks that customers want from you. But there is a Chinese company that has more quality bricks because they are pioneers in what? In that. Then at the end of the day, you find yourself, you're resulting into what we call overtrading. Am I putting knowledge? Then, underutilization of capital at the inception of the company. When we say under capitalization, at the inception of the company. Do you realize that for people who are practicing, they advise every time the company is expanding, you go and review your articles and memorandum of association. That implies go and change your share cap. Most Ugandan companies, because at the time of inception, the amount you pay for registration of the company depends on the share capital that you declare. In most cases, if the share capital is above 1 million, you are supposed to pay 1% of the share what? Capital. But if it is below 1 million, the registration fees can go up to around maybe 50 to 75. So because you want to avoid the pre-registration costs, then you say, let me start with. But as the business is expanding, at inception, you started with your share capital, maybe 1 million. But look at a scenario, you want to invest in any item or you want to put up a plant that is 1 billion. Then when the banks are coming in to offer you money, the first thing they look at the size of your share what? If now you are someone who is interested in investing in someone's company, you realize that the share capital, the equity is 1 what? 1 million, but then they want to invest in an activity that is worth 1 billion. So at liquidation, we are assuming the value of the company is 1 what? Can you risk to invest there? Because you know that at the end of the day, you may realize someone is telling you, we've lost the money, but our share capital, as per what we have, it is 1 million. So can 1 million compensate for project 1 billion? Remember in the accounting equation, assets equal to equity plus liability. So that's why you realize companies keep on restructuring the share capital. You started with 1 million. As you're growing up, then you say, now let us change, and we say now the share capital is 500 B. That is when you convert from a private limited company now to a public what? Or you call others, because you're realizing you want to go for big ventures, but the share capital is limiting you to go into for big what? The company is growing, but then the bank is telling you your share capital cannot compete favorable. So do you realize that the undercapitalization as share capital is limiting you to have resources as capital? Because a public fund, a public institution will have to put a prospectus, I think in a prospectus, that is calling the public to come and buy shares. Are we at par? That is undercapitalization at the time of inception or registration of the company. They are basically. Then another one is redeeming long-term loans. Redeeming long-term loans. The causes redeeming long-term loan without replacing. But these things are in your book. Long term redeeming long term without replacement. Like five years ago, I was working. The best way to bring it out, I'll tell you a story. I was working in some companies called Associated Scale. One day I was with my boss. I told him, his dream was to make factory that makes spades, LTU. But every time he wanted to import the machinery for the spades, he could go in the bank and get a loan of 1 year. But remember, this loan is supposed to be paid back within a period of 1 year, but then it will take him 5 years to repay back, no, to install the plant. You get the logic? You're using short-term sources of finance to finance long-term obligation. So if now you have long-term loans and we are saying redeemable, now it comes to the bonds. You got a bond and then you must have to clear this bond within maybe a period of 5 what? Then you're now coming back to see that you're redeeming it. When we say redeeming it, meaning that you're bringing it at a closure. What do you think will happen to me, the owner of the loan? Who gave you the loan? When you 1 million and you're supposed to pay me within a period of 1 year. Then for you, you realize that you want to stop this loan, you redeem it within 3 months. Don't you think that on my side, I'm losing interest? What happens to the banks? What do they say? Do you know what they charge you, what you call early settlement? So now, when they are charging you early settlement, that is an indicator that now you over what? You took the loan to finance long short-term obligations. So that is an that is a cause of overtrading. If you know that you're going to use the loan for day-to-day operations, then why would you go for a long-term what? A long-term loan. That is in the capital structure debate. Are we at par? Are we at par? Am I speaking sense or I'm speaking to myself? So meaning that you're breaking the terms, and every time you know the banks. If we have the bankers here, if we agreed 10 years and you're paying me after 2 years, the banker is forfeiting it, then they will charge you at the settlement. Are we at par? Then we are saying doing too much quickly without long-term capital. And here, when I talk of long-term capital, let us focus ourselves on equity. What we should classify more as long-term capital is the money, our money, and it does not attract interest. But now you're using too much of debt. If maybe when it comes, have you heard of the capital structure debate? You'll have that in advanced financial reporting. You know that the business is financed by either debt or what? If you go to audit a firm and you realize that equity is 10 and the debt is 90, but they are saying we are performing well. Do you realize that every time you have debt, you pledge securities? So any single mistake you make without paying interest or failure to pay in time, the assets are in danger, meaning that now you have a going concern issue. So what does that imply? It goes back, meaning that with the resources, we are growing, we are expanding, but we don't have enough resources that can cater for the institution. So we have to control our expansion because the expansion comes with the costs. Are we at par? Then they are saying poor control of our working capital. Of course, now this is a very big problem with even most of us at an individual level. But when salary is paid, we find the at Cafe Javas, at Cafe Seri, for ice cream. Every day you've been taking ice cream from Fidelity for 5,000, for 2,000. Then when salary comes, you are at cafeteria at 8,000 a scoop. Then because now that is poor what? Poor control of our working capital. Every time there is money, we enjoy the working capital. When there is no money, then we cry. So that calls for over trading. Are we at par? Then we look at the symptoms. How can we know? How can we know that someone is doing over what? Over trading. How do you know that what? You're doing over trading. Now that you've overexpanded, look at a scenario, you've expanded. Initially, you had 10 employees. Now you feel like everyone is interested in your product. You're opening up branches across every district of Uganda. How many do we have? Politicians. Politicians, do we have politicians here? How many do we have? Let's say okay, 100. So now if we have,
because more they might create one.
then meaning that now you have 1,500 employees. Now the question is, now that you've expanded and you got it, do you realize that the wage bill and the salary is increasing? But is it a guarantee that expansion is directly proportionate to increase in revenue? So now what will happen? The first symptom is a shortage of cash to meet companies' obligations. You've expanded and you've increased now the number of staff, but however, you don't have money that will pay the salaries of what? Of staff. Meaning that every time you see a company that has a shortage of staff, shortage of cash, and you realize that they have very many workers, the question is, why would you recruit all of them when you don't have the operations that can bring in what? Can bring in money. That's why you realize your friends who are MDs, all CFOs, you say, when you buy your he says, I don't need a CPA. Let me use this one of a bachelor's, because he knows he will bring you on board a CPA you want 1.5 million. Yeah, the lowest, and people are saying, you know that the tellers are getting 800 and comfortable. Yes. And now some people are saying there are CPAs that are even getting below that. They are there. You just need to be having a CPA alone does not make you correct. You may be people having CPAs, but when they cannot prepare even financial statement. They are there. Today, that is what we are discussing in there down. We are saying people pass CPA, but they call this person, they say, actually, I want to disclose. There is an accountant, she finished the CPA like in 2 years back. She got a job of a project. She's working on a research project, but she could not account for these things. She is paid every month. They pay half $4 million. Then I was there and she called me. She's like, you come and see. Then I came. She told me, how do we handle this? I said, now, if we are to do together, you first disclose to me your salary. Then, yes. Then when she told me you are getting 4 million, I said, I take it too. You also take it too. Because we are going to work together, but it is you who's going to appear. And it is my knowledge. For you, your ignorance, you have the CPA, but you cannot prepare the financial statement. And the money is in the consultants. The future CPA is for consultants. For you, you sit at the table, people are doing consultants out. Huh? And there are very many CPAs here. They can only prepare financial statements when they are given a question paper. Sales, that's what she was telling me. Where are the sales? Because she's used the sales, less cost of goods sales returns, but the donor is saying wiring the money via EFT, and then the donor is giving a rate. And then at the same time, when the money comes to Uganda, they do the money at the BO rate. So there was now, and there was a problem of now, the differences, accounting for foreign exchange differences. and she's not knowing that she must. So take note. Then the second one, we say the shortage of cash. Then the second one is the fast growing business. Fast growing business which lacks cash resources to support. We are saying the cash growing.
James Mew.
The fast growing business which lacks cash resources to support opportunities brought by its rapid operations. I think this one is also very clear. Haven't you ever been there? If it comes to a personal level, there are people that have the ideas, but then they don't have resources to what? Cash resources to fund the ideas. The company, you've done investment appraisal. The company is fast growing. They are avenues, but they don't have resources to support the opportunities. Now that is a symptom of over what? Over trading. How did you get the avenues? That's one thing. You know that getting the avenues, it requires research and development. So meaning that you need the initiative to do the research and identify that the market is virgin, but at the same time, we don't have the cash resources to what? To take over the market. So that is a sign of over trading, because you spent money to get the information. How will you know that in Guru, they need the OD when you are in Kampala? Then Roman number 3 is failure to deliver on time and seeking to extend the delivery period. Every time, have you heard of every time for those people, if you look at the invoices, when they are quoting, the suppliers are quoting for you. They will say quotation period, or what they say validity is 14 working what? Days. Then from 14 working days, they say 14 working days. 14 working days, then they say payment period. Then under payment period, the person is saying also 30 what? Then they also come and say, because it's you who was quoting, you're saying the valid days is 14 days, the period of payment, you want your payment to be done in 30 what? Then in the next thing we ask you, what is your delivery what? Period. Then you're saying, I will deliver also in 14 working what? Working days. Then after 14 working days, we've given you a contract or the LPO. You've not enhanced the order. Now, what does that imply? You don't have resources to finance the activities. It happens, the companies, they can't source jobs, the jobs come in. When the jobs come in, you have a land title that is worth 200 million. But the worker that you've gotten is worth 400 million. You can go to the bank and the bank is telling you the land title we have is worth 200 million. So we can only give you up to 70%. You can receive 140 million for sale value. But then the delivery is 14 working days and you need more what? Meaning that at the end of the day, you cannot meet the supplier's needs. You're failing to deliver in time to the customers. And that happens to quite a minimum mingi, the gitulemo kolachi, or delivering. So that is over trading, meaning that you expanded, but you don't have the capacity to do what? To do the work. Then relying on short term other than longer term finances. Relying on short what? Short term finance rather than longer term. I'm still asking myself, why did the women float shares to the market? Don't you think that Umeme, if it had a project to do, they would have used their own money? Don't you think Umeme had even just retaining the profits, they would comfortably? But when you go into the depths, we realize that shareholders at end of the year, they want to receive a return. So every time you don't give a return to the shareholders, they perceive the company to be risky. I invested in you to get money, and now you're not, every time you're retaining. So if you start now thinking of developing and investing in longer term obligations, but then you're now using short-term liquidity, then at the end of the day, that is meaning that you're vulnerable. That's why they are saying relying on short-term other than long-term to finance company activities. If I'll say an example, if you want to build, for people, or maybe some of us, if you want to build, you want land, you want to have a house, and you want for it is worth maybe 100 million. Then you go to the bank, you want a salary loan, and then you ask for salary loan of 1 year. But knowing that 1 year, if you're receiving maybe to the tune of 12 million or 15, you're a professor in Uganda. Professors in Uganda receive 15 million. So you're remaining maybe with a net of 10. And the 10 can ably cover up the loan. But the question is, won't you need subsistence? So you find yourself that before even the bank chops the money, it finds there 7. So meaning that you're using short-term money to finance long-term obligation. So why would you go for long-term investments using short-term what? Investment. Meaning that you're trying to take up what you cannot take up. So every time you use short-term finances to finance long-term obligations, that is overtrading. You better leave it out because you're going to receive the return after some period of what? So some period of time. Then very rapid growth in sales, very rapid growth in sales, very rapid growth in sales. Very rapid growth in sales. For those of you that have done marketing, do you know that every time the sales are increasing, also the marketing and distribution costs are increasing? Sales, they are directly proportional to effort. When you sit, the customers forget you. Every time you remind them, the customers remember you. If we can ably agree, would MTN be still advertising when we even have the lines with us? Would it be advertising? But every time it remembers that Airtel has put Kabaka birthday run, they say, we introduced MTN marathon, but we should also bring something new and add on the advert. Meaning that you're looking at this growth in sales, but you're not looking at the impact of the costs on the sales. And remember, growth in sales, it is showing that your market value and even your expansion is increasing, but can you be in a position to control it? So you may find yourself that the sales are increasing, but at the same time also the costs are increasing. Like some of us here, every time your salary increases, the standard of living also what? Increases. If you've been driving a VTs, they increase the salary, you rush to the bank and buy a Kawondo. You buy a Range Rover, you're forgetting that also now the salary, the expenses are what? So that is over trading. At a certain time, you find yourself, you don't have resources to maintain what? The expansion or growth in sales. Then another one, they are saying the liquidity ratios get worse. Of course, we calculated the liquidity ratios. You realize that we talked of the current assets over current liability. Every time you realize that the assets you have cannot satisfactorily offset the liabilities, you are in danger, you are in negative. Current assets, the liquid assets you have, cannot pay off all the debts you have. It is like you receive a salary of 2 million, but by end of month, abakubanja babanja obukadde 2.5. So as you just offset and you accrue the next period. So meaning that now when you look at your liquidity ratios, they are getting worse, then that is overtrading. Then lastly, I want to end with this point of the bank overdraft. They reach or exit the limit. Hopefully you know that bank overdraft, they are short term, they are given to you when you have a shortfall of cash. Maybe you feel like you need to pay some supplier, but you have a shortage of what? The bank is saying, let me help you and pay that supplier. Then when the money comes, we offset. The bank gives you a period of 1 month. Then it comes to 1 month, you cannot enhance and pay the bank overdraft. That shows that you don't have money. And you have a lot of expansions, but people are not paying you. Because by the time the bank gives you an overdraft, it has seen that there are prospects that you will pay. But however, maybe the people are not even paying. You don't have, or when the money comes, it has a lot of obligations on it. Are we at par? Then we are saying we can move now to the remedies. The remedies of how we can overcome overtrading or how we can avoid it. One of the remedies we are saying increasing the share the capital base. Increasing the capital base. Increasing the capital base. You realize that somewhere, somehow, we talked of our capital structure being very small at inception. So increasing the capital base. How do we increase capital base? How do we increase our capital? How do we increase our capital? We can issue what? We bring new people on board. Let us not be selfish, meaning that now we are trying to increase to spread the risk. If then we cannot, if we cannot issue shares, what do? Huh? We get long-term what? Long-term loans, especially for strategic projects, such that we don't stress the cash flows of the what? Of the company. But you're getting short-term loans, and then you're stressing the cash flows of the company. Then the other one is reduce the level of activity. Reduce the level of activity. Have we heard of companies that are closing their branches in Uganda? And they are no longer operating in Uganda, but you hear the company is still operating in Kenya. So meaning that if you realize you expanded, but you're realizing that you don't have the resources, you don't have the cash, you're making losses. So companies cease to operate. What was the reason? Can we get examples of the companies that have ceased the operation, but they are still operating in other countries? Eh? Orange, they are saying orange. Sure. Game.
Upright.
But they are still operating in other what? So meaning that if you realize that something is bigger for you and you don't have the capacity, reduce the level of activity. Or there are companies that will have a lot of diversification. You are in real estate. Now you know Mera Investment. You know the Mera Investment. This one for Sudir, the group of companies. They are in real estate, they are in banking, they are in anything that comes. So what do? You realize that if you have a lot of expansion and you don't have money, you cut one line of operation. You reduce the activity and you focus on what you're good at. Now we know that Sudiro at least is good at these financial things. Now, anytime the government is compensating him for Crane Bank, anytime Crane Bank is coming back on board. Yes. If you're not aware, Crane Bank is after BOU. It had the highest asset base. All of those buildings you used to see for Crane Bank, they used to own them. Unlike most of the banks you see, when you look at Centenary Bank, except Mapera, all of those buildings you see, they under lease and rent agreements. But Crane Bank, all of the buildings, they were in Mera Investment. And who was the majority shareholder? Sudhir Ruparelia. And he's the owner of the what? And now the ruling is soon coming out that we should compensate. They should compensate him. And then the Ukraine bank gets back. But I don't know if people who have accounts will also receive their money. I'm yet to find out. Then maintain tight controls over working capital. Maintain tight controls. Maintain tight controls over working capital. For those of us that are in practice, every time the company is going to buy non-current assets, all the resolutions come from the board, and there are no even internal controls. Non-current assets, any procurement that is for longer term, if it is borrowing, longer term borrowing, issuing of shares, resolutions will come from the board. And the board, in most cases, we don't have internal controls that are limiting the boss because they are the bosses. But look at the people down here that are spending. Have you looked at the bureaucracy, even though you want something like 10,000? For those of you that are working for public institutions, do you realize that even though you need 50,000, you make a requisition and it goes even up to the ministry? Then you see a message, single treasury account credited on your account, as if they cannot pay you cash. So now they are putting tight controls on working what? Because they know every time everyone will request 50 times 1 million, it will become material. So we develop tight controls on working capital because we know that non-current or long-term borrowing, they are governed by the board. But it is petty cash that you always pick. They don't have control over that. So another way of limiting that is maintaining tight controls. And for institutions, serious institutions, even 5,000, the CFO will have to append the signature to the cashier. Or else, you realize that most institutions, they have a limit on cash, petty cash, 200,000. Anything that exceeds the 200,000, you'll have to pass through the process. That is over trading. And I think we should call it a day. We should call it a day. But we will put Professor in prayers. Then let's agree. I don't know if I was told you have a lecture tomorrow. And today's lecture I was hijacked because I was informed on short notice at 3. So should we proceed with the lecture tomorrow or we wait for Professor? Sorry? He said, that's what he said. Anyway, I'm going to call him.
We'll proceed with the lecture.
So let's proceed. We meet tomorrow. What time? Okay, see you tomorrow.